Welcome back to another video on Finance Value TV. In today's video, we're going to be looking at how you can invest during inflation. And this is going to be a video based on the information from the man, the myth, the legend, Warren Buffett. Now, of course, why we're doing a video on this is because right now there are serious worries about inflation, and we've chosen to highlight some of the key words that the Oracle of Omaha has actually stated. As you can all see right here, this is a small graph of Warren Buffett's net worth over time, and it's clear that he's been making some consistently great decisions as we can see his net worth rise exponentially. So in today's video, that is our goal, to look at what the very best are doing when it comes to investing during inflation. And if you've been paying attention to the markets, you'll know that inflation is rampant. There are some very worrying concerns as the market and economy moves forward. As we can all see right here, if you know who Michael Burry is, the person who predicted the 2008 housing crash, actually has been warning about inflation, and not the kind that you might think. Not the average 2% or 3%, pretty much the hyperinflation that existed in some economies quite some time ago. And this is referenced in an article. But what does Warren Buffett say about investing, and how can we invest and hedge our bets against inflation and increase our net worth and put ourselves in a better position? So this is what we're going to do. So first of all, of course, as we know, with inflation, it kind of just decreases our purchasing power. Over time, as you can all see, inflation changes the price of goods and makes your dollar worth a lot less. So before, in 1970, we could get perhaps 4 cups of coffee because, of course, they costed 25 cents. But now, you can't even buy a cup of coffee. It costs way more. And that's the point, okay? With inflation, our purchasing power goes a lot down. Now, I want you guys to pay attention to this graph right here. If we look at the purchasing power of the dollar, we can all see that it's gone down a lot, significantly, since we've come off the gold standard. It's been coming down for a very, very long time. And this is only going to get worse. So we don't know what's for the economy next, but there are some wise words that we can take a look at. So what's one of the first things that Warren Buffett does say? Okay, so this is the first point, and it says, when you were doing great, remember it's time to remember inflation. So Buffett wrote, at a moment of good performance for Berkshire, before we drown in the sea of self-congratulation, a further and crucial observation must be made. A few years ago, a business whose per share net worth compounded at 20% annually would have guaranteed its owners a highly successful real investment return. Now such an outcome seems less certain, for the inflation rate, coupled with individual tax rates, will be the ultimate detriment as to whether our internal operating performance produces successful investment results. For example, reasonable gain in purchasing power from funds committed for you as shareholders. So it does say that a business earning 20% on capital can produce a real negative return for its owners under inflationary conditions. So pretty much what that means is that what happens here is that even though the companies are doing good, and even though your investments are going up, because the rate of inflation is so high, this could mean that your investments don't actually outpace the inflationary environment. So as you can see, that's what he's saying, Of course, it may look on paper that you're doing good, but because of the inflation rate and because of the taxes that are involved, this could sort of give you a real negative return. So these are all the kind of things that you have to take into account when you're investing, because a lot of the times people are seeing the stock market go up and up and up, but they're not realizing that yes, it's going up, but inflation is also going up too. So of course you're making money, but are your investments beating inflation? And this is what he says: when you're doing great, it's time to remember inflation. So how is inflation going to be doing compared to your portfolio? So as you can see, that's what that first point is trying to make. So the next point we have here is, during high inflation, earnings are not the dominant factor for investors. So unfortunately, earnings reports in corporate financial statements are no longer the dominant variable that determines whether there are any real earnings for you, the owner. For only gains in purchasing power represent real earnings on investment. If you forego 10 hamburgers to purchase an investment, receive dividends which after tax buy 2 hamburgers, and receive upon sale of your holdings after tax proceeds that will buy you 8 hamburgers, then you'll have no real income from your investment, no matter how much it appreciated in dollars. So he's trying to say that, basically reinforce the first point. Even if you invest a decent amount and it looks like the numbers are going up, if you can't actually use that money to buy more stuff than you originally invested in, you may feel richer, but you won't actually be richer, because of course, if you lose out on 10 hamburgers to purchase something, but after all, you can only buy 8 hamburgers after taxes and everything, then, you haven't actually gained it. And this is something that people don't understand. Some people might say, oh, I'm not going to buy this $10,000 car. And then they invest, and after all their investments, maybe they're left with $8,000 after everything is actually accounted for. Now, of course, this isn't, average. Usually when you invest, you actually do gain more, but this is something to be wary of. You may feel richer, but you won't actually be richer. And this is something that you need to take, something that you need to take into account. So he says, higher rates of inflation can create a tax on capital that makes much more corporate investment unwise, at least if measured by the criterion of positive real investment return to owners. This hurdle rate, the return on equity that must be achieved by a corporation in order to produce any real return for its individual owners, has increased dramatically in the recent years. The average tax-paying investor is now running up and down an escalator whose pace has accelerated to the point is nil. So the progress is nil. So yeah, it's very hard, again, year over year for these companies to increase their profits at a rate which it makes sense for you, the investor, to keep investing and gain returns which are going to outweigh the level of inflation. So this is something that is pretty hard to do. But of course, if you can find companies that are able to do this, which we're going to get in the last part of the video, this is something that we should be doing. So the next point is, of course, understanding the math of the misery index. Now, for those of you who don't know what this means, the definition is right here. The misery index is an economic indicator created by someone. The index helps determine how the average citizen is doing economically. So it's basically a kind of just, once again, an economic indicator. And it's calculated by adding the seasonally adjusted unemployment rate to the annual inflation rate. And it's assumed that both the higher rate of unemployment and a worsening inflation rate create an economic and social cost for our country. So it's pretty much, trying to see how bad the economy is getting. And that's what the misery index is for. So it says, understand the math of the misery index. The inflation rate plus a percentage of capital that must be paid by the owner to transfer into his own pocket. The annual earnings achieved by the business can be thought of as an investor misery index. So when this index exceeds the rate of return on equity by the business, the investor's purchasing power shrinks even though he consumes nothing at all. So high inflation rates will not help us earn higher rates of return on equity. So pretty much what they're saying is that, with all this inflation going on, it's really, really hard to make a decent return on your capital. So, with the high inflation rates, they're not going to help us earn higher rates of return on equity. So it's pretty much harder to keep improving your annual return on equity, especially when we have these inflation rates going incredibly out of control, especially in our economy. So this is something that you should pay attention to, understanding the misery index. So let's go on to the next point. So the next point here is inflation is a tapeworm that makes bad businesses even worse for shareholders. So let's get into this. To continue operating in its present mode, such a low return business usually must retain much of its earnings, no matter what penalty such a policy produces for its shareholders. So of course, if you're a company, you have to actually make a profit usually. So inflation takes us through the looking glass into the upside down world of Alice in Wonderland. When prices continuously rise, the bad business must retain every nickel that it can, not because it's unattractive as a repository for equity capital, but because it's so unattractive, the low return business must follow a high retention policy if it wishes to do so to continue operating in the future as it has in the past, and most entities, including businesses, it simply has no choice. So, for inflation acts as a gigantic tapeworm. The tapeworm preemptively consumes its requisite daily data of investment dollars regardless of the health of the host organism. So, whether the level of reported profits, even if they're zero, more dollars for receivable, inventory, and fixed assets are continuously required by the business owner in order to merely match the unit of volume of the previous year, the less preposterous the enterprise, the greater the proportion of available sustenance claimed by the tapeworm. So, this is a very, very big metaphor, which is somewhat confusing. And what I'm getting from this, I could be wrong. I could be wrong in my, understanding of this, is that, inflation is just, it's once again, it just makes it really bad for the shareholders, because even if, once again, year over year, the company has the costs, as they're saying, even if it wishes to continue operating, okay, that's not what I wanted. Even if it wishes to continue operating in the future as it had in the past, it has no choice, of course, they need to do something. They need to retain their profits. So if the level of reported profits are, it doesn't really matter about the level of reported profits. What this kind of is saying is that, because costs are going up, your revenue needs to go up as well. And this is something that not all businesses realize. Some businesses, let's say you own a business, and let's say for every month for 3 years, you actually did, let's say, for example, I'm going to write this down. Let's say for 3 years, you did 10,000. Okay, that's way too big. So let's say for 3 years, you did 10,000 a month for 3 years, every 3 years. Okay, so we did 10,000 a month the first year, 10,000 a month the second year, and 10,000 a month the third year. You might think, okay, I got myself a great business, but you don't understand, because of inflation, because of everything that's going on, you're not making 10,000 every year. You're actually making less every year because of inflation. So what they're saying is that because there's fixed asset costs, of course, in order to match the volume of the previous year, this is kind of bad, because, of course, if you have some costs of your business, these costs are probably going to go up due to inflation. But if your profits stay the same, or if they're zero, this is kind of really bad, because, you're not actually progressing. So this is something that, once again, inflation is just pretty bad. So that's pretty much what that point says. So it says focus, and this is one of my favorite points from this entire article. It says focus on companies that generate cash rather than, just generate a bunch of numbers. And you guys know what I mean by that. So as you can see, it says focus on companies that generate rather than consume cash. So our acquisition preferences run towards businesses that generate cash, not consume it. As inflation intensifies, more and more companies find that they must spend all funds they generate internally just to maintain their existing physical volume of business. So there's a certain remark like quality to such operations. However attractive the earning numbers, we remain leery of businesses that never seem to convert such pretty numbers into no strings attached cash. Now, this is something that I find very, very interesting, because this is something that is so important and people don't pay attention to when investing. People invest into companies like Uber and all these new companies that don't make a return, and they invest with the hope of them making a return. Now, of course, we understand that in the long term, when you're investing in companies, so many companies barely break even or lose money, but in the future, they do generate money. Now, of course, Warren Buffett has actually stuck to his mantra of investing in businesses that generate cash. So what has he actually done with this? So we know that Warren Buffett's Berkshire Hathaway's largest holdings is Apple. Now, of course, Apple is the king of generating cash. So look at this graph right here. Look at the Apple cash reserves by quarter. This is absolutely insane, and one of my favorite graphs to look at, and why Apple is pretty much one of the top companies in the world. You can see that year over year, they've increased their cash reserves. Now, cash is critical to any business. If you understand investing, you understand that many businesses, why so many businesses during the coronavirus pandemic went out, was because their cash reserves were low. And this means, that they can't like withhold the storm. The coronavirus pandemic was a storm to a business, Businesses running on small margins, businesses with high expensive costs just got completely wiped out. But companies like Apple, because they have all of this cash, that means that they can, they're going to be around for a very, very long time, which is good. So back to the original point, he's pretty much saying invest in companies that generate cash and have a clear path, because there's so many companies that just have these high revenue numbers, but they don't convert. They don't convert into any real world tangible value, and they're not going to be anytime soon. So when you're investing for inflationary periods, make sure you invest for cash. And as you can see right here, this is another graph which shows once again the huge amounts of cash that Apple actually has. And not just Apple, we've got Microsoft, we've got Alphabet, and we've got Amazon. Alphabet is actually Google. So of course you can see that, these companies have a good cash balance, because when it comes time to invest in the research and design in many different sectors of their company, they can do so with each. Now, of course, you can see that the profit margins is actually really small. But the cash, Apple compared to Microsoft and all these other companies actually has huge cash reserves, which is why it's such a safe and stable investment, because, they're pretty much never going to go bankrupt anytime soon. Now, of course, this is only 2017. Of course, I know that. But if we look at the more recent data, Apple is still performing well. So the next point we have here is another great one by Warren Buffett, is look for companies that can increase prices and handle a lot more business without having to spend a lot. So, of course, most of us are not billionaire buyers of corporations outright, but in Buffett words on what makes a great acquisition in the 1981 letter touch on inflation as one of two key factors that make a great acquisition candidate. Companies that through decision or accident have purchased only businesses that are particularly well adapted to an inflationary environment, such as favored business, must have two characteristics: an ability to increase prices rather easily, even when product demand is flat and capacity is not fully utilized, without fear of significant loss, and an ability to accommodate large dollar volume increases in businesses, often produced by more than inflation than by real growth, only with a minor additional investment capital. So, what does this mean? This basically means that businesses that can really adapt to this inflationary environment. So, what he's talking about here is the ability to increase prices rather easily is something that not a lot of companies have to do, okay? So companies that are great examples of this are companies that we just talked about, okay? Apple, okay? Apple has been increasing the prices of their iPhones, okay? Apple has a ridiculous monopoly on their brand. They can increase their prices, okay? And they're not going to lose profits. People are always going to buy Apple because of their insane brand loyalty. People are always going to be buying Apple, so Apple can just keep increasing their prices adjusted for inflation. So this is something that's really good. Now, I want to show you something that you probably haven't paid attention to, okay? So something that probably almost everyone uses is Netflix. Now, with Netflix, okay, we can look at the price of this. So if we take a look at Netflix, we all know that Netflix over time has been increasing their price all the way from what it was, which was $8, and to now it's $16. Now, why is this so good? Okay, because Netflix doesn't really have much operating costs. So this is a company, it is a great investment because over time, with inflation adjusted, you know, they can just keep increasing their prices, which means when it comes to their revenue, their bottom line, their margins, they can keep these in check because people are not going to leave Netflix just because they've added $1 on. As you can all see, they haven't increase this price so dramatically that the customers are going to fall off. And this is what you need. You need to look at businesses where if they increase their price, are people going to flee? Is the business model going to be under some sort of kind of threat? So as you can see, companies like Netflix and Apple, these FAANG companies, these digital companies that are easily able to rotate, change, and do all these sorts of adjustments are companies that make great investments. So as you guys can see, Netflix has been just consistently increasing it, which is something that people always complain like, oh, Netflix is increasing this price again. Yeah, inflation is coming, okay, and they don't want to lose their profits. So this is something that, you know, you got to pay attention to. So the next point we have here is that corporations cannot outmanage the government. So one friendly but sharp-eyed commentator on Berkshire has pointed out that our book value at the end of 1964 would have brought about one and a half ounce of gold. And about 15 years later, after we plowed all back earnings along with much blood, sweat, and tears, the book value produced will buy about the same half ounce. A similar comparison could be drawn with Middle Eastern oil. The rub has been that government has been exceptionally able in printing money and creating promises, but is unable to print gold or create oil. We intend to continue to do so as well as we can in managing the internal affairs of the business, but you should understand that the external conditions affecting the stability of currency may very well be the most important factor in determining whether there are any real rewards from your investment. So, of course, the thing is, what he's trying to say is that, you know, companies, they can only do so much, okay? If the Federal Reserve decides to wreck the economy, okay, it's not going to be up to Berkshire Hathaway or Apple or Microsoft or Google or Uber or whatever stock you're investing in to produce that return for you, okay? You have to understand that corporations, they can't outdo what the government does, okay? Which is why you have to have a diversified portfolio. You know, if you watched our video last week, we talked about Ray Dalio and how you should have a diversified portfolio, and that's one that is among different currencies. So yeah, you can't outmanage the government. This is something that we can't do. Right now, we've got the Federal Reserve printing all with the quantitative easing, trying to help the economy back into the pre-COVID state. But this is something that, you know, we will just see with time how this thing pans out, because right now it's very scary times. We've got so many different indicators that this is going left, this is going really badly. But once again, corporations can't outdo what the government does, so we have to pay attention to what the government does so we can kind of realize that maybe stocks might not be the best investment and maybe we might not outperform inflation just there. So this is basically just saying that, you know, pay attention because you know, the company can only do so much. And, you know, number 9, the last point from this article, which is a great one, is that there is no solution to inflation, but there is a reason, maybe just a little for hope. So the chances for very low rates of inflation are not nil. Inflation is man-made. Perhaps it can be mastered, the threat of which alarms us also may alarm legislators and other powerful groups, prompting some appropriate response. So it basically is saying that there's no real solution other than to try hedge your bets against it. But inflation is always going to be there. We know that the Federal Reserve targets, I think it's around 2% or something like that. This is, you know, the average rates of inflation. And of course, at different periods of time, there were different rates. But of course, just understand that inflation is going to hit. It's going to be here to stay. And it's something that you always have to take advantage of. So There are many different currencies out there, though, that you could be investing in that, are experiencing deflation, all this kind of stuff where the currency actually increases in value, and unlike the dollar. So this is something that you should all pay attention. If you did enjoy today's video, don't forget to leave a like, don't forget to subscribe, and we'll see you in the next video.